In this video, I'll be going over Work Together Problem 8-1 on journalizing notes payable transactions. This is from the Century 21 Accounting Advanced Edition textbook by Gilbertson Lehman, so credit to them for this text and this problem. So first transaction we've got is June the 4th, signed a 90-day 10% note with Second National Bank, $5,000, receipt number 223. So we'll come up here to our cash receipts journal because we're getting cash when we sign for this note. They're giving us cash, right? So it's June the 4th. This is going to be to notes payable. Eventually, it's a liability. We'll have to pay it. Document number receipt 223. And then it's going to be a general credit to the notes payable. That increases that liability account, $5,000. And it's going to be a cash debit, $5,000. Okay, next one, July the 15th. Again, we've got another note we're signing and receipt number 240. This one is 120-day 8% with Commerce Bank, and we get $8,000. We're just borrowing money all over. Okay, and then December the 6th. This one says we drew $5,600 from a line of credit, receipt number 368. So this time, instead of a notes payable, it's a line of credit. And receipt 368. And the proceeds on that were $5,600 is what we're taking out. There we go. That is part one. Now for part two, we're over on the maturity dates and interest tab, and we will calculate the maturity date of each note payable and the total amount of interest due at the maturity date. Okay, so the number of days on this June the 4th $5,000 note was 90, so we'll put 90 days remaining up here. And then the second one was 120 days. Okay. So what we know is that from June the 4th to June the 30th will tell us the number of days in June that we have. This one's a little bit trickier, but I'm going to give you a little hint. If you type in the two dates, 6/30, just whatever year, and then 6/4 that year, you can actually come up here and just equals the 30th minus the 4th. And it will give you the number of days that were in that month. So that's a little bit handier than counting them by yourself. So then the days remaining after June would be the 90 minus the 26, 64 more. Okay, in July, we know that there are 31 days, so we can just carry this formula down. So we have 33 more to go, which means we used all of August, 31 days. Right, 2 more to go, which means we'll only go September 1 and September 2. Will give us the 2 days in September to get us down to 0, which means that September the 2nd would be our last day, our maturity day. Okay, and then we'll do the same thing for the 120-day term on this note. So we're starting on July the 15th through July the 31. We'll do the same thing. July 5th, we'll start with the 31st and 7/15. And you can just quickly subtract those. Would give us 16 days in July. So 120 minus the 16 is 104. And we'll do August, September, October. There's 31 in August, 30 in September, 31 in October. We'll carry our formula down. We have 12 more days after October, which means November 1 through November 12 would be the 12 days we need. And there we go. That's our maturity date. So we figured out the maturity date, but now we've got to figure out our interest due at the maturity, right? So in this first one, we have $5,000 principal. That's the original amount of the note. And the interest rate was a 10% note, is what the book told us here. And the time as a fraction of a year. So it's out of 365 days in our book. So I went ahead and filled that in for you. And it's just a 90 out of 365. You might have to put an equal sign in front of that to make it calculate. Okay. So the interest for the fraction of the year is just principal times interest rate times time would be $123.29. You could go ahead and put that in dollars so that it rounds appropriately. So your next one is an $8,000 note, and the interest rate is 8%. And your time is 120 days, so equals 120 divided by 365. So your interest, we could just copy and paste that formula, would get us to $210.41 interest for this note for the fraction of the year that it's out. Okay, that's part 2. Now we're back on the Journals tab here, and we're going to do part 3. Journalize the following transactions. Use the maturity dates and interest amounts calculated in the previous instruction. Okay, so our first one, the June the 4th note, we figured out was a maturity date of September the 2nd. So that's the day we're going to pay it. So September 2nd. And we are going to pay off the notes payable, which means we'll have to debit that $5,000 that we credited up here to get it to go away, right? To pay it off. And then we're also going to have interest expense. And we figured that amount out. We'll just grab it off the other tab by using equals. Go over there, 123.29. There it is. Which means our cash credit will be those two amounts added together. Okay. And what check number was this? We were going to decline the autofill. And it was check number 345. Right, what's our next note? The July the 15th note. And it was November the 12th is the date. So we'll go November 12th, notes payable, and interest expense. Check number 652. The note was for $8,000, and the interest we calculated over here was $210.41. And so then over here, we'll just add the note payable and the interest expense together. We wrote our check for $8,210.41. And now on December the 31st, we paid cash on the line of credit, principal $500, December's interest $46. This one is going to be line of credit. We'll have to debit that, and we'll have interest expense. And this one is check number 887, I think is what it says. And the amount we paid on principal was $500. And remember, we took out significantly more than that, but we're not paying all of our line of credit off yet. We're paying $500 though. And we're paying interest of $46. So we'll add those together to get our cash credit. There's what we paid on our check. And that would be it for Work Together 8-1. Of course, you'll get to do the on your own.